Good afternoon. This is Rich Morrison, and welcome to my latest edition of the Thinking Cap, where today we're going to talk about the heat check. The heat check is a column that I've been writing in my daily market report letter now for a couple of years. I'm going to talk about what it is, why it's important, and how you can use it when you're making your marketing decisions. Where to find it? Well, if you're not familiar with the market report email, this is what the email looks like that comes to you in your inbox every day. Over here on the right-hand side is where I'll give a little bit of blurb about the markets. And then right here, the NAU Country Market Report, the date. This is where you click on this line right here, and it'll take you into the market report email letter. This is the one I'm writing today, Wednesday, April the 3rd. This is the front page of the letter. The heat check column sits over here on the left-hand side. Now, what is the heat check? Well, the heat check, the idea behind this is to show you the markets that are hot and the markets that are not. The hot markets are the ones in red. The hot markets are the ones that are pushing into what we would call overbought territory. Those are the markets that if they don't make a high yet, they're probably going to be doing it in the relatively near term. The not markets in blue, those are the ones that are getting oversold. Those are getting pretty cheap right now. And at some point, they're going to reverse and go back up. And so if I'm marketing those crops or those animals, I don't want to be selling when my markets are in the not zone. I want to be taking advantage of the red or the hot zone. And so you can see what's going on today. The big movers as I'm recording this today are the metals markets, precious metals making new highs, the gold market at an all-time high right now. You can see on the chart right here, June gold, I've got at the top of the hot list. The relative and what constitutes a hot and a not market. Really, the things I'm looking at are the charts. The relative strength index, that's this green line right here. The RSI measures the buying or selling, really the volume of trade in an ascending or descending market. And so when the market's ascending, it's going up. And usually when the RSI is rising, that means there's still a good volume of trade. What tends to happen though, I always compare this to a wooden roller coaster, that when a market starts to get towards its top, it runs out of steam, like a roller coaster does as you get towards the top. Even though you're still high, you're running out of momentum. And that's what happens when the RSI often gets above 70, this little red dotted line. And so when the RSI is over 70, I consider that a hot market. Also, if you look at the stochastics at the bottom, those are very similar. These are measuring different times, the 9 and 14 day, but you can see that, you know, as they're starting to do the same thing, and you can see the ebbs and the flows in these things. And there are a lot of traders that just trade markets based on the indicators at the bottom of these charts. They don't even have a clue what soybeans may look like, but they'll trade the soybean market just off the RSI or just off the stochastics. And a lot of people will say, you know, when the red line crosses the blue line, that's the short-term stochastic. When it crosses the longer term, that's a buy signal or a sell signal, depending on whether the markets are going up or down. But you can see we've got several markets over here. The metals markets right now, you've got RSIs in the mid to upper 70s, stochastics in gold, the short term at 87, which tells me that market's getting really toppy. What was one a week or two ago that was up here? It was the stock market. If you look at the S&P index, last week I had that in the heat check. We had the nearby stochastic up into the 90s, which meant that market was probably due for a correction, and we did happen to see that. Flip down to the bottom, you got the cattle markets, the rice market. Rice has been very oversold for a number of days right now, making new contract lows right now. So looking at some of our markets, where are we at, and why is this a concern? Well, I just showed you the cattle market. For different times over the last several months, I've talked about livestock risk protection. LRP insurance is a way to basically buy a put option to protect against the downside in the marketplace. If you did that over the last month or two, you feel pretty good about it today because the markets have come down. You can see the RSI now on live cattle at 36, stochastics even down into the teens. Tells me this market's probably nudging towards being an oversold market. The 50% retracement line right here. These are some others. Also, if you look at the other lines on the chart I didn't talk about, The red line is the 9-day moving average. The blue is the 20-day. The gold is the 50-day moving average. The purple is the 100. The light blue is the 200-day moving average. And oftentimes these moving average lines can be resistance or support. In addition, I've drawn these other dotted lines in here. These are our retracements. So from the December low to the March high, we've retraced 50% of that move at the low here over the last few days. And in fact, we've traded just below it, but we haven't closed below that 50% retracement at 174.70, which I think is key support right now. Since we had moved below all the other moving average lines, we'll see if that can hold us here as we go forward. And if it does, probably would start to take cattle out of the not zone and maybe back into a neutral zone. The feeder cattle market, very similar looking chart. The RSI at low 30s, stochastics would tell me this market oversold right now. First goal is to get above, close above the 100-day moving average going forward. Then we'll see if we can get back above these short terms, the 9-day, the 20-day, maybe constitute the next move up. But you can go back and look in February, this market was way overbought. You know, LRP made a lot of sense to be able to protect, give yourself some downside protection. The hog market right now is the one that's moving to the upside. And you can see the RSI at 67 right now. Stochastics pushing up into the 80 level. So this market making a new high here this morning. And so we'll watch that pretty closely. This is your next candidate for protection, whether it's forward selling, whether it's buying LRP protection, whatever it is, take a look at it in the hog market. The cotton market. So I had May cotton in the not zone, but December cotton is actually continuing to push a little higher. And you can see that the 9-day and the 20-day moving average nudging a little bit higher. You know, I'm calling this most neutral, but it's kind of nudging into hot territory right now. The RSI still at 55, but you can see short-term stochastics at 82, longer-term 77. I'm trying to decide whether or not to include this in the hot zone here tonight, but certainly it's a market that's, you know, if it gets another little nudge, we're only a penny off the contract high that was made last month. The December corn chart, pretty neutral right now. You look at the RSI at 50, stochastics in the 50s, pretty flat after today. We got a little bit of a bump today, up 3 cents after the last couple days sell-off. And you can see how tight all these moving average lines are. The 9-day, the 20, the 50, they're all within 2 cents of each other, and that's where the market's sitting right now, which tells me this is a pretty darn flat market right now. We're not overbought. We're not oversold. This really doesn't have any I don't even know what you call it, but there's nothing really to say about this market at the moment. And we're sitting within the middle of the range that we've traded over the last 45 or 60 days. November soybeans, kind of similar. RSI at 54, stochastics in the 30s, 40s. We did nudge higher. You know, things have turned higher a little bit today, but we're still within all of these moving average lines. And then finally, Chicago wheat, again, kind of similar. We're maybe in the upper part on the stochastics, but you can see this market really hasn't gone anywhere. There's no way I can call this overbought right now. Maybe if you get back up to the 100-day moving average at 603, you know, then we start taking a look at maybe this market as being overdone to the upside. But at the moment, calling it pretty neutral as well. So I invite you to go out, check this column each day, even if you don't have time to read the letter. Just look and see which contracts are in the red, which ones are in the blue. That's going to tell you about everything you need to know. I don't want to be in the business of telling people when to make sales, but boy, this method of being able to identify a hot and a not market is really, really good, and it tells you a whole lot over time. And you can go back and trace what we've shown you over the last 6-8 months. You go back to last summer when the markets made their highs. You know, you had the corn, the bean market well up into the red for 4 or 5 days, and then things sold. And that's what tends to happen over time. So check this out. If you got any questions, shoot me a note. Thanks for checking out the Thinking Cap. Hope you have a great day.